Thanks, Cal, and thank you all for inviting me to the meeting today, and thank you for coming. I'm going to talk a little bit about the Templeton philosophy and then also about the Frigate and Treasure Harbor portfolios. Sir John Templeton was the founder of the first global mutual fund. I worked for the Templeton organization, Templeton, Galbraith, and Hansberger, for 9 years. And then after Franklin bought Templeton, Tom Hansberger walked across the street and started Hansberger Global Investors, also with a focus on value. And I worked with him for 16 and a half years. So I'm very steeped in value philosophy. Sir John Templeton was one of the founders of value investing. He himself was a very spiritual person, the founder of the Templeton Prize, which each year gives out awards to those who have progressed with spirituality. He embraced all sorts of different types of religions, so he's very holistic. And his investment approach, although value-oriented, was holistic as well. He felt that you shouldn't just focus on U.S., but also look at opportunities abroad. There are similarities, as we've mentioned, to the Buffett approach. It's looking at value, it's looking at forward valuations, and it's fundamental analysis as opposed to technical. The criteria that he used, which may be adjusted over time, but the focus is still on price to earnings. So the price of the stock today versus the potential earnings for the company over a cycle. I say adjusted because we typically would adjust the price for the dividend. We also look at price to net asset value. That's what the equity shareholders get. Price to cash flow, similar to the Buffett approach. And then also we're looking for good companies with strong or improving fundamentals. So this philosophy has been applied to how we have managed the Frigate and Treasure Harbor portfolios. This is a snapshot of the Frigate portfolio. It has 47 securities. We have on this slide that it does have a very value tilt, large cap company value tilt with low price to earnings, sales, and book value, which you want to be low if you're a value manager, but high yield. I compared these to a benchmark, an international benchmark, and to even display more the value characteristics of the portfolio. The PE is 15 versus 20 over 20 for the benchmark. The price to book of the benchmark is 2.8 times, and the yield of the benchmark is only 2%. The statistics we have provided, this is provided by Folio for the beta and the volatility. The beta is less than 1, which means, and the volatility is low. We wouldn't expect it to move as much as the market, and hopefully we're going to be adding the return through alpha. I tried, although the portfolio is built from the bottom up, we work very hard still to give diversification across countries and industries. That is a consideration when you're doing international investing because of the impact that currencies and politics can have on companies. The largest exposure is Western Europe, not including the UK. UK is the next largest market. And then we have Japan and emerging markets. North America includes Canada, and there's just a small piece of cash. I should mention that both Frigate and Treasure Harbor are constructed of ADRs. So these are domestically traded international securities. The advantage being of that is that we don't have all of the costs associated with investing on individual markets around the world. We can buy these in the US. The disadvantage is it's not as large of a sample set that you can invest in, but it does give us enough, obviously, for diversification and to put together a pretty darn good portfolio, in my opinion. This is the sector diversification. Again, this fell out from the bottom up, but I'm still glad that we do have diversification. Banking's the largest, pharma or healthcare is next, consumer, such as Unilever, et cetera, is one of those. We have industrial, telecom companies, et cetera. So there's a nice diversification, but these aren't going to be the tail that wags the dog. This is the performance of Frigate from inception to May 16th. It has captured a lot of the upside in the market with a 17.9% return. It was hard to find a benchmark. I found an S&P ADR index, which is 20.7%. So it did lag the index, which is what you would expect in a very strong market. There are some technical things as well. If you note, on the first day, we invested Frigate in the morning, and that afternoon the market fell 1% from its peak. So we kind of captured in on the model performance a little drag right there. Plus, of course, the index doesn't have to put up with trading costs or fees, et cetera. This hasn't been operating for a full year yet, so these are unofficial numbers. What I will say is I have looked at the performance of other international managers, especially year to date, which have a higher degree of resources to apply than ourselves. And this has been very competitive versus other managers. Next, we're going to look at the Treasure Harbor snapshot. Thank you, Carol, helped me out, actually constructed the slide with the data that I gave him. You can look and see that Treasure Harbor is a much more concentrated portfolio. And the focus on Treasure Harbor is to have good dividend yields. I'm using this as a diversifier for domestic and international bonds and for domestic portfolios that have high dividends. So this is an international folio with a focus on yield. You'll note that it has 29 securities. If you look at the characteristics, it is even much more value-oriented than Frigate, with a very low price to earnings sales, price to book. The yield is historic at 4%. I'm estimating that the yield is over 4.5%, the dividend yield. The beta is very low, and the volatility is also relatively low. On the next slides, we have this was a very interesting portfolio to put together from the standpoint that you don't have internationally the same sort of yield opportunities as you have in the US. You don't have the MLP, you don't have the REITs, and to be honest, a lot of these companies, like real estate companies abroad, do not pay out as much of their earnings. They don't have as high a dividend yields. So putting together an ADR portfolio with yields like this was a challenge, but I think we still did a good job and still maintained, even within these characteristics, some nice diversification. There's an advantage to UK being the highest exposure, and that is that it also has a more liberal taxing policy as far as they don't withhold taxes on dividends, whereas many other countries do. So that's a little advantage for Treasure Harbor. But it still has good diversification across other countries as well. And we did obtain some diversification across industries as well. Again, banking is the largest, telecom is next, energy, utilities. But again, it's not strictly what you would expect from a yield type of folio. And so I think it does give good diversification for, again, bonds, both domestic and international, and also for versus yield portfolios in the U.S. I was visiting an investor last month. I like to visit investors because they hold you accountable for what you're doing. And he mentioned to me that he just thought that it should be easy. I should try to capture all the upside in the market plus and also perform better than the stock market and down markets. Well, that's kind of hard to do, especially if you have a value bias, but still it's something to think about. On the next slide, we have the Treasure Harbor performance. Now, this was launched in October, so it didn't have that 1 quarter of high performance that Frigate was able to participate in. There really is no ADR yield portfolio or benchmark that I could find to compare Treasure Harbor to. That's how unique of an investment this is. But what I did is a blended benchmark with a 2 spider exchange traded funds, 85% being an international ETF with no emerging markets, and then 15% with an emerging market ETF. Both of these spiders are supposedly focused on dividend yields. Versus this custom index, Treasure Harbor, even after fees, unaudited, has done very well. And over this time period, it has done very well versus the S&P ADR index, keeping in line with that. So maybe there's something to the fact that we can participate in both up markets and down markets really well. I would say that one of the reasons the performance of this is good versus its peers, which is just showing very good versus its peers, and the benchmark, is that value investing in international markets has done very well. I have to say another thing that I apply when I'm doing the investing is I like as much as possible to actually go and visit the companies. I have visited almost all of them that are in both portfolios. In March, I went overseas. For those who know me well, I seem to hang out where there's trouble. As in Japan during typhoons and earthquakes, and Spain and air traffic controllers, and UK when there's dust clouds, ash clouds. And so after Putin actually invaded Ukraine, I was over in Europe. Spent 2.5 weeks going through 4 countries, at least 6 cities, and several a conference and several investor days, looking at opportunities, and I think that's really important to do. And hopefully that'll be reflected, that sort of due diligence will be reflected in the performance over time. Just wanted to touch on some of the key holdings. Thank you again to Cal for finding the logos for the various companies. I can't tell you exactly, especially what that BHP Billiton logo means, but it's interesting. These are BHP and BG Group. The BG stands for British Gas, are 2 of the largest holdings in the Frigate folio. And Orange, or Orange, since it's a French company, is largest holding at this time in Treasure Harbor. This does not mean that they will stay the largest holdings. It's just through appreciation and through other reasons they are the largest ones now, and that's why I'm going to talk about them. BHP it's actually both Australian and UK based. It's a diversified global resource company with especially good strength in iron ore, but also petroleum, potash, copper, coal, aluminum, manganese, and nickel. BHP is going to benefit for the urbanization and growth in emerging markets. Even if the growth has slowed down to some extent in China, it's only above 7% now. There is still going to be urbanization, i.e. people moving to the cities, people building bridges, train tracks, etc., and it's going to require natural resources. BHP will benefit from that. They also have very good management that makes disciplined use of capital for the benefit of shareholders. For the first half of 2014, the return on capital for BHP was 22%. So the assets that we've entrusted for them, they've done a good job on. When they make an investment, their focus is to incur an ROI of greater than 20%. For the first half of 2014, they don't have a December year end. They generated net cash of $5.6 billion. They have a low price to book and a low estimated PE and a nice yield. BG Group, also known as British Gas. They are both upstream for exploring and producing energy, and they also transport globally and develop liquid natural gas. They have an advantage. There's going to be growth in demand for liquid natural gas. There appears to be a shortage. The company's going through some difficult times now with Egypt as far as not being able to do carriers out of there as much as they would like. But over the long run, I expect that they're going to benefit from their network and the demand in LNG. This is cash from operations of $7.8 billion in 2013. Now, a lot of this cash in the short term is going to be going not just to a dividend, but also into investing for the future. So don't confuse that with net cash, but it's still a nice cash flow. Price to book's a little high, something to look at, something to consider. They have earnings growth over the next 5 years estimated at 28% per annum. Orange. Why they've named it Orange when it used to be called French Telecom, I don't know, but that's what it is now. It is French-based, we'll forgive it for that, but it is present in 30 countries with a base of 239 million customers. It is a leading provider of IT and telecom services to multinational companies and also to individuals. You might remember that telecom companies, when mobile started up, became the rage. Then they blew up with the tech bubble. They became interesting again for value investors, and then nobody cared. But now interest is coming back again as pricing competition has become more disciplined. The competitive environment is stabilizing, but there's still good growth in emerging markets. One of the reasons we've included Orange in the Frigate or Treasure Harbor portfolio is that it does have a dividend yield estimated at 4.95%, and I believe that they should be able to maintain, if not grow, their dividend.